Hey, good morning, everyone. Marty Missouri here. It's Friday, the 17th of November, 2023. This is your weekly economic update. This one's going to go pretty quickly. I want to make I think, real important initial point about next year's setup for corporate profits, and then I'll go through a few of the inputs. This one's going to be short largely because I covered about 4 of our inputs in yesterday's market snapshot to make a point that I wanted to make in that video. So I don't want to do that again. I assume everybody who's watching this video watched yesterday's. If you didn't, I think that was an important video to watch. So please go back and grab that one when you have time. As for the score of our index, it was flat. We actually had a couple moves. Industrial production dropped a point, so that was negative, but the various sector ratios to S&P 500 improved a little bit week over week, enough to bring it from negative to neutral. But when we square everything else, essentially we broke even on the week. Still very much in the territory that says recession odds are too high for comfort going into next year. So the point I wanted to make just going in, I really captured in this morning's commentary that I wrote leading into the video commentary. I shot it yesterday, but sent it to clients this morning. So I mentioned Walmart just briefly. To pound home their expectations about the consumer, here's their CEO. We may be managing through a period of deflation in the months to come. Now, I said I cannot stress enough what such a scenario would do to corporate earnings, particularly this go-round. So folks, again, as we've suggested it would, the market is partying on the kind of data that actually confirms our larger concerns about the economy next year. And that data starts with disinflation, slowing economic signals, and the view among market participants that this is great because the Fed's going to cut interest rates. I did say in yesterday's monologue that you got to think about that. If things just continue to improve, why would the Fed cut interest rates? Particularly if markets are, responding positively to that. They may conclude that interest rates are where they need to be to keep things steady as she goes. And if they cut them among a Goldilocks soft landing scenario, well, then maybe inflation comes roaring right back. So this narrative that the Fed is going to cut as things slow but aren't recessionary, I think is a very risky narrative to hitch your wagon to. I do think that rates will drop next year because I do think a recession is highly likely, and the Fed will have to respond to that. But if we don't get recession, if our assessment of the data is incorrect in terms of the risk, we're not really saying we know that there's a recession, we're just saying the risk is high. Well, then I don't know that we should anticipate the Fed cutting interest rates. So it's a very interesting, kind of stuck in a corner kind of narrative. It's if the market doesn't go into recession, the Fed doesn't ease off, inflation heats back up, the Fed starts raising interest rates. I will say this, folks, this economy is still cyclical. The world economy is cyclical, despite what politicians and central banks would love to have happen on their watch, which creates issues down the road when they try to circumvent these things. But a recession is inevitable, whether it's next year or 5 years from now. And if it's not next year, then the conditions that would bring it on, and maybe even worse than it otherwise would have been, persist. Now, back to my point here, that what this would do to corporate earnings. Think about that chart. I call it my Wile E. Coyote chart that I often pull up, which is our leading economic indicator to coincident economic indicator, being at levels it's never been without either being in or in close proximity to recession. And then corporate earnings holding way up there over the cliff, and I show you history where it tends to fall with our indicator, and it's not falling yet. Well, Walmart CEO thinks actual deflation, but even if we go with disinflation, think in terms of the underlying cost structure for companies that have developed these past 3 years. We know about labor costs, right, among other things. Well, inflation and companies' ability, thanks to mass stimulus, to raise prices at historic rates has definitely kept their margins in the green and therefore kept them and the markets very afloat to this point. When I talk about margins, though, and profit growth, when you think about the nominal GDP growth of like 8% the U.S. saw in the third quarter, right? And then profits only grew to like 4 to 6%. An analyst with Morgan Stanley made this point this morning, and I couldn't agree more. She said, that's abysmal relative to what the economy actually did. And that's because underlying costs are going up. Now, underlying costs are going to be stickier than prices, right? And that's what I say here. Imagine a future per what you've gathered from our look at the data, as well as commentary from people like Walmart CEO, a future that may be merely months away, where prices have to come down amid corporate cost structures that are, let's say, far stickier than the prices they can charge. Folks, that's problematic to the nth degree, and it's very, very consistent with what I've been showing you in the historic charts. And this is very consistent with this late cycle, end of cycle narrative. The data is weird, it gives you mixed messages, and so on. It's always the case. The folks who are still kind of living in the past and believe that the Fed can fix everything, a lot of them really haven't managed through a serious recession. That something like half the analysts on Wall Street and the people who are giving advice via the financial media weren't even around in 2008 and all these other times. I started in 1984 to actually experience these things intimately. So COVID was strange because of $5 trillion of stimulus, fiscal, and $5 trillion of money printing by the Fed. That was strange. That circumvented what was going to be probably a historically ugly recession. And here we are, without the benefit of having a real recession and purging all the froth and the excesses that come before recession during the previous expansion. Things get stupid late in the cycle. Well, here we are with things maybe even stupider. So we have some concerns, which is why we own things like gold, treasury, money market funds, why our biggest two U.S. sectors right now are staples in healthcare, and why we're hedging the S&P with put options all at the same time. Because if indeed we do get that big sell-off, we want the same response from our portfolios like we had when COVID hit, because we were hedged. We just captured, just a fraction of that decline. This go-round, though, I think the setup is more obvious, that a real buying opportunity will be presented if we do see that last leg down. So we want to be positioned in a way that we don't capture all the decline, hopefully a lot less of it than everybody else, and be in a position to apply our liquidity to our best ideas going forward. Okay, so that's that, folks. I just can't emphasize enough why right here we want to be patient. We can just do this real quickly. As I mentioned, our index didn't change. Mortgage apps ticked up just a little bit, still very historically low. Mortgage rates have come down a little bit. They were north of 8. Now they're, I think, mid to high 7s. Just a little bit there has been enough to bring, I think, some people into the market. Showed up a bit in U.S. housing starts. As you can see here, though, this is single family. Most of that was in the multifamily starts space. Permits ticked up just a tick. We had slightly more permits in the multifamily than we did the single family. This is a single family. Here's one I did show you on the earlier video. Home builder sentiment is kind of in the gutter, so to speak. This is a pretty good indicator, and this is very much in recession territory, and the home buyers traffic is as well. Capacity utilization, to the degree that factories are running at full capacity, 78.9 isn't horrible, but it's the trend, and you can see the level here. Look at it as it crosses those red shaded areas. So these are previous recessions. So capacity utilization suggests weakening in the economy, but we knew that already about the manufacturing sector. Cass freight index, both shipments and expenditures rolling back over, consistent with our economic thesis right here. And then last but not least, I just thought I'd throw up the copper chart. Doesn't really give us much of a signal right here other than it's coming off the bottom, which is consistent with our technical analysis here. A few weeks ago I showed you the falling wedge and the bullish divergences, and it just peaked up above its 50-day moving average. Now, this is counter to a weak economic thesis. Copper should not do well in a recession, which is why we aren't taking on the full positions in areas that would really do well during the next cycle, which relate to things like copper, because we see recession coming and we think there will be a dip. Now, the one thing copper has going for it, though, is probably China. And so China could be a serious tailwind for copper going into next year, because their economy is an utter mess, and they are incrementally, seems like almost week after week, coming up with new programs and stimulus plans and so forth. And the way China does it, a lot of it ultimately revolves around infrastructure now, and a lot of that is green energy infrastructure too, and of course that's a heavy burden on copper as well. So we could see a situation where we have a recession, but China continues to stimulate and continues to consume lots of copper in the process. So you can make an argument that maybe copper doesn't have the kind of hit during a recession. We're not willing to play that particular narrative that it'll do okay. We still think it'll go down. We did get out of our ETF that's in base metals futures. We still do have exposure to miners, however, and we'll have more of that during the next cycle, I highly suspect. So folks, I am going to leave it there. I hope you all have a wonderful weekend. I want to thank you as always for watching and listening. Be back next week. Take care. Bye-bye.